In recent months, the Indian rupee has touched a historic low against the US dollar, trading close to 90 rupees for $1. This has raised concerns about inflation, imports, gold prices, foreign travel, and India's position in the global economy. But an exchange rate is not an isolated number. It is an outcome. To understand what this number actually means, we must understand how currencies work, how India's currency system evolved, and why depreciation keeps recurring. How currencies get their value. A currency is a medium of exchange accepted within an economy, but its value, especially against other currencies, depends on the exchange rate system under which it operates. Broadly, there are three exchange rate systems used globally. First, fixed exchange rate systems, where governments set the value of the currency and defend it using foreign exchange reserves. Second, managed or pegged systems, where currencies are allowed to move, but within limits, with frequent central bank intervention. Third, freely floating systems, where currency values are determined by market demand and supply, with intervention only to prevent disorder. The more control a country wants over stability, the less flexibility its currency has. The more flexibility it allows, the more volatility it must absorb. India today operates a managed float. But this was not always the case. After independence in 1947, India did not allow the rupee to be freely traded. This was not unusual. Most countries at the time controlled their currencies. India followed a strict foreign exchange control regime. The government decided who could buy foreign currency, for what purpose, and at what price. Imports were licensed, capital flows were restricted, and the rupee's value was administratively determined. Why did India choose this model? Because India faced three binding constraints: extremely low foreign exchange reserves, heavy dependence on imports, a weak post-colonial economy. A freely floating rupee under these conditions could have collapsed rapidly. So India chose stability as protection, not flexibility as growth. During this period, the rupee was effectively linked to the British pound, reflecting inherited trade and financial ties. When Britain devalued the pound in 1949 and again in 1967, India was forced to adjust the rupee as well. Early India treated currency as a shield, not a competitive tool. 1966, India's first currency shock. The most significant early shock came in 1966. Before devaluation, $1 was worth approximately 4 rupees and 76 paise. After devaluation, it moved to around 7 rupees and 50 paise, a depreciation of roughly 36%. Why did this happen? It was not ideology, it was pressure. India had fought a war with China in 1962 and Pakistan in 1965, sharply increasing defense imports and foreign exchange outflows. At the same time, consecutive droughts in the mid-1960s caused severe food shortages, forcing large food imports under the US Place 480 Food for Peace program, paid for in dollars. Exports were weak, imports were rising, foreign aid and loans came with conditions. International lenders believed a cheaper rupee would make Indian exports competitive. So what happened? Exports did not rise meaningfully. Why? Because price competitiveness does not help if an economy lacks export-oriented manufacturing, industrial scale, global market access. Devaluation without productivity only makes imports costlier, it does not create exports. This failure deeply shaped Indian policy thinking. India doubles down on controls, 1966 to 1980s. After 1966, India became even more cautious. From the late 1960s through the 1980s, trade, capital, and foreign exchange controls remained tight. The rupee appeared stable, but this stability was artificial. It reduced volatility, but at the cost of efficiency and competitiveness. While India remained inward-looking, the global monetary system itself was changing. To understand that change, we need to go back to 1944. Bretton Woods, why the dollar became dominant. World War II had collapsed global trade and currencies. Countries were competitively devaluing, hurting each other. The Bretton Woods Conference was designed to stop this. Its goals were stable exchange rates, predictable trade, global financial cooperation. The US dollar became the anchor currency because the United States held about 70% of the world's gold reserves, had the largest industrial base, was the world's biggest creditor. The dollar was pegged to gold at $35 per ounce, and other currencies were pegged to the dollar. This system brought stability, but also imbalance. Bretton Woods created global stability by concentrating monetary power in one country. 1971, why Bretton Woods collapsed. By the late 1960s, the US was spending heavily on the Vietnam War, welfare programs, global military commitments. To fund this, the US printed more dollars than it had gold to back them. Foreign governments began demanding gold instead of dollars. The system became unsustainable. In 1971, President Nixon ended the dollar's convertibility into gold, the Nixon shock. This ended Bretton Woods and ushered in the era of floating exchange rates. From this moment, currencies were valued by markets, not gold. Dollar dominance and its global cost. The US dollar remained dominant even after gold backing ended. This gave the US enormous advantages. But for many other countries, it created vulnerabilities. Because global trade, commodities, and debt are priced in dollars, countries that earn in local currency but borrow in dollars become fragile when the dollar strengthens. This has happened repeatedly. In Latin America in the 1980s, countries like Mexico and Brazil collapsed under dollar debt during US rate hikes, the lost decade. In East Asia in 1997, dollar debts became unpayable when currencies collapsed, triggering the Asian financial crisis. Countries like Argentina, Sri Lanka, and Pakistan have faced repeated crises due to dollar dependence. Even advanced economies like Japan suffer import inflation when the dollar rises, though exports cushion the impact. The dollar does not need to attack other countries. Its strength alone exports instability to weaker economies. This explains why many countries build reserves, control capital flows, or resist full openness. India's cautious response, and its cost. India watched these global crises carefully. Even after Bretton Woods collapsed, India retained exchange controls and delayed integration with global markets. This reduced short-term volatility, but postponed competitiveness. By the late 1980s, pressures accumulated, persistent fiscal deficits. Rising oil import bills, worsened by the Gulf War. Narrow, uncompetitive exports. Growing short-term foreign borrowing. Then the system broke. 1991, the breaking point. By 1991, India's foreign exchange reserves fell to about $1 billion, barely enough for 2 weeks of imports. International lenders refused fresh credit. Essential imports like oil were at risk. India had no buffer left. To raise emergency funds, the Reserve Bank of India pledged 67 tons of gold to secure loans of about $400 million to 47 tons to the Bank of England and 20 tons to the Union Bank of Switzerland. The gold was not sold, but the signal was unmistakable. Currency crises are not about pride. They are about liquidity. 1991 reforms and the new rupee. This moment forced reform. In 1991, the rupee was devalued. Trade was liberalized. Capital markets were opened. India moved to a market-determined exchange rate. From this point onward, the rupee reflected economic fundamentals. Since then, 17 rupees per dollar in 1991, 45 rupees by 2000, 60 rupees by 2013, 75 rupees by 2020, around 90 rupees today. This depreciation is not random. It reflects four structural gaps. Higher inflation erodes purchasing power. Slower productivity growth limits value creation. Persistent trade deficits increase dollar demand. Volatile capital flows amplify pressure. Currencies weaken when fundamentals diverge for decades, not overnight. Why the rupee is under pressure today? Today, the rupee faces pressure because the US dollar is strong. India imports heavily. Global capital is cautious. India imports over 85% of its oil, most electronics, and 700 to 800 tons of gold annually, all priced in dollars. Oil alone makes up about a quarter of the import bill. Gold plays a special role. It is cultural insurance, but economically, gold imports widen trade deficits and reinforce currency weakness. In contrast, China runs trade surpluses, tightly controls capital, actively manages its currency, and holds over $3 trillion in reserves. China treats currency as an industrial policy tool. India treats currency as a market outcome. What should India do? So is a weak rupee bad? Not automatically. Exports become more competitive. IT and services earn more in rupees. Tourism benefits, but persistent weakness is diagnostic. It signals import dependence, limited export complexity, and vulnerability to global capital cycles. India does not need to defend a number. It needs to strengthen fundamentals. Reduce oil and electronics imports. Build export complexity, not just volume. Raise productivity through skills and technology. Attract long-term capital, not hot money. Shift gold demand toward financial instruments. India's currency story is not a story of mismanagement. It is a story of delayed competitiveness. Currency weakness is not the disease. It is the symptom. The exchange rate is not just a price. It is the report card of how an economy works. And the choices India makes now, on trade, manufacturing, energy, and productivity, will decide not just where the rupee trades next year, but where India stands in the global economic order for decades to come. If this helped you even a little, hit like and subscribe so you don't miss the next one.